Let's get Michael Famoroti, who is the chief economist at Vetiva Capital Management, to speak to us for a few minutes and get to explain how our animal spirit is being crushed as we speak for the last 3 days. $1.5 trillion wiped off global stock markets in just 3 days. Michael, good morning and welcome to the program.
Morning, boss. It's a pleasure to be here.
Thank you. What's your spirit right now?
My spirit is fine, thank you. Not quite how the markets are doing, unfortunately.
So you think this animal spirit that started late 2016 is now evaporating? Michael? Michael, my question was, do you think the animal spirit that started in 2016 is now
important?
Please go ahead.
Yeah, it's important to put the story of the market runs that we've seen in the last couple of sessions. It's important to situate it in the post-2009 global economy, really, because for the last 8-9 years, the US Federal Reserve has allowed cheap money in the global economy in efforts for it to boost the economy. And what we've seen in the last 18 months is it's begun to unwind that process. And whilst it is not the overriding driver for the routes that we have seen, because frankly, the US market is probably overpriced at the moment, a change in people's expectation of how monetary policy may evolve in the US, particularly because of the new Fed chair, that is something that has made the markets panic quite a bit so far this month, and is probably what has caused the timing of this sell-off.
Nigeria is part of the global market route, or do you think we have some sentiments of our own here dragging our own equities market?
Well, I think it's a mixed bag. No country is an island, and any significant changes to global capital flows, especially from the US, are going to impact the market. We know that foreign investors are a significant part of the Nigerian market, so we must take into account how the global picture is evolving. That said, the decision to invest in Nigeria is one that is going to be based on their perception of risk-adjusted return. On that front, Nigeria can be quite confident because the risk environment has improved significantly. We know the equity market has struggled at the start of this week, but so far this year we're up about 18%, and that reflects a renewed confidence in the economic and corporate landscape. So I think when you're adding the fact that there's also currency stability, the risk environment is a lot more attractive for investors to come in. Naturally, they will balance it with alternatives in more safer markets.
The natural question moving forward, Michael, is how do I trade this market correction in our own space on customs trade?
I think for the Nigerian equity market, I won't say we're seeing a correction. If anything, the correction that we saw was at the start of the year. So a lot of people have been mentioning that the Nigerian market was undervalued, probably still is relatively. And what has happened is that there has been a repricing of stocks as the risk environment has changed and as people's view of lower interest rates this year have come into play. So we are probably seeing a new support level for stocks, and from here on in, it's probably time to start to pick your winners, because corporate performance will become a much stronger driver of share performance than just a general bull sentiment.
In just about 30 seconds, how long do you see this repricing likely to last?
So I think for the Nigerian equity market, we're at a sort of low period. I think as earnings come in, then we'll probably see the final batch of this phase of repricing. But like I said, it's going to be quite uneven. So the market is going to reward stocks that have done well or they believe have good expectations for 2018, whilst the stocks or the companies that lag behind are likely to be punished. So I think that's the final stage of the repricing on the domestic front. On the US scene, indications are this is just start. So like I mentioned before, the market is heavily overvalued. If you look at the dividend yield or the P/E ratios in the US markets, on the S&P, on the Dow Jones, there isn't enough of a fundamental justification for why share prices have performed this well, especially when the outlook is of higher interest rates. So we may likely see it continue in some capacity.
Okay, Michael Famoroti, thank you very much for raising the curtain on the program for us today.